Hey everybody, it's Ian Beamer, Guaranteed Rate, coming at you with another market update for December 2023. A lot going on since the November update, and a lot going on really over the last probably 8 weeks or so. We're coming off another Fed meeting last week where the Fed, once again for the third meeting in a row, decided to hold rates steady, leave them unchanged at 5.25%. And following that meeting, Powell really shook up the economic world when he commented that the Fed is now focusing on making rate cuts, basically when to make rate cuts and how much to cut when they do start making those cuts. So I believe he said he's planning on 3 rate cuts in 2024. Most economists believe those rate cuts will start somewhere around the April or May meetings. I believe the markets at this point are pricing in possibly 4 or more rate cuts, even though the Fed just said they were planning on just 3. But they're just planting the seed. But as soon as those comments came out, it really for the last 2 months since the Fed's been leaving everything steady, been leaving interest rates unchanged. Mortgage interest rates have recovered quite a bit. So we've had personal consumption expenditures and consumer price index both drop quite a bit since their 2022 highs. We're down over 50% for each index. And these are indexes, they just kind of measure inflation. They're different bundles. They're bundles of different goods measured as far as what the dollar will get you at any given point in time. So, like shelter, energy, gasoline, etc. So, basically, inflation is coming down, and it continues to come down even with the Fed leaving interest rates alone. So, the Fed is now thinking that at some point next year, the economy may need a little boost. So they're going to start cutting rates, which is great news for home buyers, for homeowners, for all of us. I mean, it's great news for businesses. Businesses can start borrowing money, even though employment numbers remain strong. Unemployment actually went down in November, which is pretty surprising to most. But we did have the auto unions, United Auto Workers unions, come back to work. So don't think that did not play a role. So that definitely factored in. Your U.S. Treasury bond over the last 8 weeks, since really the mid-October, you can see a trend on that yield. So the 10-year U.S. Treasury bond is really what I tell clients to watch if they're trying to figure out which way the 30-year fixed interest rates are going to go. As far as mortgages. So if the 10-year U.S. Treasury bond comes down in yield, typically interest rates follow suit. Now, traditionally, over the last 50 years or so, pre-pandemic, the margin between the 10-year U.S. Treasury bond and the 30-year fixed interest rate was about 1.72. We've talked about that a number of times on past market updates. After the pandemic, we had something called quantitative tightening. So during the pandemic, we were doing our third round of what's called quantitative easing, which this is kind of technical, but bear with me. I'll try to give you the layman's terms and keep this simple for you. Quantitative easing was an artificial way for the Federal Reserve or any central bank to keep interest rates low. So what the Federal Reserve did was they would purchase large quantities of U.S. Treasury bonds and mortgage-backed securities. And when they made those purchases, they're increasing demand on a fixed supply. So therefore, they were driving up demand. Supply stayed the same. Interest rates could come down because lenders didn't need to supply higher interest rates in order to get interest and get investors to purchase those securities, those mortgage-backed securities or U.S. Treasury bonds. So quantitative tightening is the reverse of quantitative easing. So all those securities that the Fed had purchased during quantitative easing now have to be unloaded or sold or come off the books. So quantitative tightening was when the Fed is selling U.S. Treasury bonds and mortgage-backed securities. So they're creating an oversupply of these securities, which, in addition to them raising the federal funds rate, this also drives up interest rates. So the fact that the Fed is now coming out saying that they're thinking about making cuts to interest rates leads economists to logically make the assumption that they're also going to end quantitative tightening. They may not start quantitative easing. They're not going to start buying U.S. Treasuries or mortgage-backed securities again, or at least not for now. But the reduced supply will then get the difference, the margin between that U.S. Treasury bond, that 10-year U.S. Treasury bond, and the 30-year fixed interest rate closer together. So traditionally, like I said, for 50 years, we were about 1.72% above. The 30-year fixed interest rate was about 1.72% above the 10-year U.S. Treasury bond. And then during quantitative tightening, that had gone up to probably about 3% at one point. So we see that margin once again coming down. Since mid-October, that 10-year U.S. Treasury yield has dropped over 1%. Over that same time period, mortgage or U.S. 30-year fixed mortgages have come down almost 2 points. So at one point, we were over 8%. Now we are well into the mid-sixes, possibly even low sixes. So that margin is shrinking again. We're trying to get to a more normal market. We're still significantly above, obviously 1.72%. We're 3.9, would give us somewhere around 5.6%. We're not there. We're not there yet. We're still mid sixes, so we're still significantly higher than we had been pre-pandemic, but we're getting closer. So if you combine that, the market is returning to normal, and that margin is getting narrower again, and the Fed is going to start cutting interest rates on the Fed funds rate, I think we can expect interest rates to improve quite a bit in 2024. A lot of people believe that we'll see interest rates in the fives. A lot of people think this will continue into 2025. Some people think we may see interest rates in the fives by the end of the first quarter of 2024. We'll see what happens. Nonetheless, what does this mean for you? So for those of you that have purchased a home in the last 2 years, post-pandemic, since interest rates have been soaring, just skyrocketing since the pandemic, and the Fed has been hiking the Fed funds rate, a lot of you will be looking to refinance. So that's good news for you. For those of you that have not purchased yet, that may be looking to get in the market, I would expect, obviously, homes to become a little more affordable because it's cheaper to borrow money. And I would also expect more homes to come on the market. A lot of sellers have been apprehensive about parting with their interest rate that might be in the threes for an interest rate that would be 7 or 8%. That's not something, not a situation a lot of homeowners want to jump into. But if they have an interest rate in the threes and interest rates are maybe in the fives, that's a little more palatable. That I can do. So if we're sitting on the fence for the last couple of years, maybe you were waiting to make the move closer to family, waiting to make a move for employment reasons, waiting to make the move for whatever reason, you can put off that move for so long, but eventually you're going to have to make that move. So we expect the number of homes for sale, the number of transactions to, at the very least, return to pre-pandemic numbers. So we're down about 20% as far as purchase transactions from a year ago today. So a year ago, we were about average for, from 2019 to 2015. We were on par. We were on par. Obviously, during the pandemic, when the pandemic first hit, transactions slowed down. They took a big dip. You'll see that in the chart below. Then you see them skyrocket thereafter for two reasons. For number one, they they dipped down during the pandemic. Nobody could go out and see houses. All of us were kind of locked in place. We couldn't view houses. We couldn't make transactions. For those of you that were trying to close a refinance, you may remember driving up to the title companies and having title companies let you sign the documents in your car because they wouldn't let you in the offices. So it was a crazy time. Think of trying to sell a house. You can't have an open house. Nothing was in person. It was very difficult. So transactions dipped down. The second reason, obviously, was because interest rates dipped so low. So you're going to have a lot of transactions when it's very inexpensive to borrow money. So obviously, transactions jumped way up in late 2020 with cheaper interest rates. And then those transactions have really been slowing down since 2021. We expect the number of transactions to return to a more normal market, possibly even peak above the 2015 to 2019 numbers. So you'll have more inventory, you'll have more selection, and interest rates will be lower for that purchase. So hope this helps. Hope this helps make your holiday season a little more joyous, and enjoy the new year. Please DM me if you have any questions. I look forward to hearing from you. Thanks for checking out this video, and I will talk to you very soon. Happy holidays, everybody. Take care.